If you've got $1 million saved in your investment portfolio, you've done a lot of things right in life. You've not only sacrificed for many decades, but you've scrimped and you've saved and you've worked really hard for all of your gain. And I'm going to show you a tax planning strategy that could help you save over $100,000 in lifetime taxes based on your investment portfolio size. Asset location. That's the tax strategy that we're going to cover in this video. You see, most people, when we're saving, we don't really focus on where we're placing our investments. We're just focusing on buying the investments. And that causes a huge problem down the line when you ultimately have to pay taxes on a lot of your tax deferred gains. So if you're in a 401k, you're in a traditional IRA, you're in a 403b, 457, right? All of these accounts, you're going to wind up paying a very large tax bill at the end of the road. And so if we can be strategic about where we place our investments and not necessarily put everything into a tax deferred account, but also utilize the brokerage and the Roth accounts, well, now we can actually set up our portfolios to be very tax diversified and save a lot of money in taxes. So I'm going to show you an example here. Don't get too caught up in the numbers, focus on the concept. But we're going to assume you're retired and you've got a $900,000 portfolio. Why didn't I pick $1 million? I just want to keep the math nice and easy, and you'll see that in just a second. We're going to assume you have a 60-40 portfolio, meaning 60% of your money's in stocks, 40% of your money's in bonds. Now, let's say you've got 3 accounts open. You've got your traditional IRA, you've got your brokerage account, and you've got your Roth IRA account. Now, all of these 3 accounts are actually taxed differently. So depending on what we put in the account could lead to a big tax advantage or a big tax disadvantage. So let's run through the example of what pretty much 99% of people do, and probably what you do watching this video, which is just blindly investing your funds into different accounts without even paying any attention to taxes. So we're going to assume you've got $300,000 of VOO, that's just the S&P 500. Now, we're going to assume also that you're in the 24% tax bracket, and that this grows at 8% over 10 years. Now, at that time, you're going to pay $155,000 in taxes on the growth of that portfolio and the actual value of the underlying assets. Again, don't get caught up in the calculations, focus on the concepts. We're also going to assume that you've got $240,000 of NVIDIA stock in your brokerage and $60,000 of US Treasuries in your brokerage. You can see the expected returns and the tax rates that apply, but at the end of the day, in 10 years with these assumptions, you're going to pay $117,000 in tax in your brokerage account. In your Roth IRA, we're going to assume that you put $300,000 of corporate bonds in that account. Now, in the Roth, there's no tax, so you don't owe anything in 10 years, but there is tax when you put money into the account. We'll assume you were smart and you put money into your Roth when you were in a low tax bracket, and so you only paid 12% in tax. So the tax in that account would be $36,000. Again, don't worry about the numbers. The glaring error in this situation, which again is what 99% of people do, is that they just blindly bought investments in random accounts. Right? Your Roth accounts, you always want to have your most aggressive assets in that account, like your individual stocks, not bonds. Why? Because if those stocks appreciate dramatically, you don't owe any tax. And those bonds that you're getting interest every single year that you're forced to pay tax on, well, we want to shelter that in a tax deferred account and let that compound without any tax drag. And our ETFs like VOO, right, buying the S&P 500, these index funds, we actually want to put that in our brokerage account because those index funds are very tax efficient. And so in a brokerage account where we're paying tax every year, we want tax efficient investments in that account. So in this example, the total tax that you'll pay by year 10 is $308,000. I got this just by adding up all of the taxes in those individual accounts. But what if we're more strategic about where we place our investments, right? We're going to actually apply asset location. So let's recompose those portfolios by placing the investments in the accounts where they are taxed most favorably. So what we're going to do, we're going to shuffle things around here. So in our traditional IRA, where ordinary income tax applies, we're going to take our corporate bonds from the Roth, move them in here, and we're going to take those US Treasuries, also bonds, from the brokerage, and we're going to move them to the IRA. Now, the total tax owed in 10 years in this example is going to be $115,000 based on the expected growth and the tax rate of 24%. In our brokerage account, we're going to take the S&P index fund and we're going to move it into the brokerage account. And what have we done? Well, we've shifted the tax rate on that brokerage account from 24% down to 15%, the long-term capital gains rate. We just saved 9% in tax on every dollar that we did this. Now we're going to take $60K of those corporate bonds. replace them with municipal bonds, which are tax-free. So now we've taken bonds that were being taxed at 24% and we've dropped it to 0%. And we're going to save a massive amount in tax. And in fact, in this case, we're only going to pay $42,000 in tax in our brokerage account over 10 years. And in our Roth IRA, we're going to pick up that NVIDIA stock that was in the brokerage account, move it to the Roth IRA, and now we've dropped the tax rate from 15% on that stock to 0. And because that stock has the potential to appreciate very quickly, all the gains are going to be tax-free. If that 240K becomes 2.4 million, it's all tax-free now. And we're going to take 60K of the S&P 500 ETF, VOO, from the IRA, move it to the Roth IRA, same concept. We're dropping that tax rate from 24% right down to 0, and the taxes owed are going to be nothing. And so now if we compare the total tax that we're going to pay in 10 years in this example, it's $193,000. And so you can see there's a massive difference, right? Taxes paid in this example with no asset location strategy being applied, $308,000. Taxes paid with asset location strategy applied, $193,000. So in this example, we were able to save $115,000 in lifetime taxes on a roughly $1 million portfolio just by being wise as to where we're putting our investments. I use asset location with every client that I work with at my wealth management firm. In fact, the slides that you're viewing right now are from the retirement planning course I teach at Johns Hopkins University. And so if you would like to have a tax planning strategy like this applied to your own situation, just shoot me an email, Raul@DocShahFinancial.com. I'd love to hear from you and your personal situation and how I could help you. And until then, like, comment, and subscribe.